Hello everyone. This video lecture will cover one comprehensive example that we don't have time for to go through in our face-to-face lecture. It's going to be about flexible budgets and full variance analysis. So it's pretty I would say a little bit advanced. So be patient when we work out the question together. So first of all, I would assume that you have read the question already. So I'm going to just come to the answers, steps directly. So you have some information regarding the budget, and you have the annual manufacturing overhead budget, and this is what's happening here. And basically, it talks about these values, some actual, some actually budgeted. So there are a lot of issues going on there, and some fixed, some variable, and you will be asked to find answers from 1 to 5 and be sure to identify each variance as favorable or unfavorable. So it's actually pretty standard question in this chapter, but it's pretty challenging because you have to be familiar with all the technical things and also make sure you find the answers correctly. Okay, we don't need to explain the reasons causing these variances, so that's a plus. However, make sure that in the real practice and also in the applications, sometimes you are asked to explain what the reasons causing these variances. Okay, so let's take a look at the first question: total manufacturing overhead costs allocated. Okay, so now it's kind of we come back to the drop costing and drop costing method. So remember in the chapter 4 when we first time introduced the drop costing method, and we do have a manufacturing overhead cost control and allocated, remember? So this is something that we're going to do here again. So first of all, according to the question we have manufactured basically 72,000 units. Okay, basically that was the data, that was actual production. So we have 72,000 units manufactured, and we have the budget. Okay, we have the budget sitting here. So in order to manufacture 672,000 units, and we need this direct manufacturing labor hours. So therefore you can figure out, okay, per every unit we are supposed to have how many budgeted hours. Okay, and also we do have the cost, the manufacturing cost. The manufacturing cost per unit also is given, so which we can find that in a minute. Okay, so we're gonna show you that number is. All right, so let's go ahead find our question. Okay, and find a solution to this particular answer. So I'm gonna put the question 1 here. So first of all, we need to find out, okay, in order to find allocated budget manufacturing overhead, okay, we need basically 3 things. Number 1, how many actual units of output, okay, and the budgeted hours allowed per unit, and the manufacturing rate per hour. So we need all 3 elements before we can find the budgeted allocated manufacturing overhead costs. So what I'm going to do is the following. Okay, I'm going to first put the allocated, okay, manufacturing overhead, and this one equals the multiplication of the following. Okay, so first one, we need to know the actual units manufactured. Okay, they're multiplied by the following. The next thing is we have to know, okay, so it's kind of a quantity of budgeted allocation base allowed per unit of output. So I would put the budgeted, okay, labor hours, okay, allowed per unit of products. Okay, then definitely we want to multiply this by finally, okay, the manufacturing overhead rate per direct labor hours. So you need to have 3 of them. Okay, the 3 of them. So that's how you can find out. And for this one, I would also call that basically the budgeted. Okay, you can see that there's only one actual here, the number of units manufactured, and this is kind of SOP, okay, and this is kind of budgeted rate that we have. So that's how we journalize these manufacturing overhead costs. So by the end of fiscal year, as I said in the chapter 4, we are going to reconcile, so we may over allocate or sorry, we may over allocate or we may under allocate, so we have to make adjustments to make sure the CGS and inventory costs are not inflated or deflated. So that's basically the reason we want to do that. Alright, so let's keep going. So we need to find a bunch of numbers. I think this one we have already. We know that this is 72,000, that's given. So we have a manufacturer 72,000 so far, okay? And for the budgeted manufacturing overhead rate per labor, I think you can visit the question here. Okay, this question here. So this is 0.99. That's the number we're using. Okay, that's the number we're using. So that's a manufacturing overhead per direct labor hours. Okay, so that's what do we have here. So we're going to use this number for sure. Okay. So in this table, you can see that pretty much everything here we're looking at budgeted, and this one is actually the actual result. So somehow we can easily figure out, okay, the difference between them and so on and so forth. Okay, so for this 0.99, that's basically the budgeted number. Okay, so we're going to take a look at that in a minute. And also I want you to spend 1 minute on this table. So basically, if you divide the total amount, and be careful, this is annually budgeted. Okay, if you divide the total amount by 12, that's how you get the monthly MOH budget for May 2014. Okay, so keep that in mind. Divide this one by that, you get a monthly payment. Okay, make sure that you know that the first 4 columns we're talking about the budgeted numbers, and this is the actual one, and this is annual number. We're looking at the unit level and monthly level and budgeted and actual. Okay, so make sure you know how to read this table. So now let's get back to our question. Okay, so I know that this is 0.99 according to my question, but for this one I need to find out. Okay, I need to find out. It's not given directly, but it's pretty easy to find because the sentence here said the manufacturing overhead budget for 2014 is based on budgeted output of 672,000 units, requiring 3,360,000 direct labor hours. So therefore I can figure out, okay, in order for me to manufacture 1 unit, how many hours it will cost. So I'm going to divide this number by the output to figure out kind of a efficiency, how many hours it will take to manufacture 1 particular unit. Okay, so what I'm going to do next is I will go ahead find the answer, which is I'm going to divide, okay, budgeted, okay, budgeted direct labor hours, okay, then by budgeted actual output. Okay, so apologize for that. Okay, I think I need to hang on here, so I'm going to get rid of that. Okay, so that's basically how how we do this issue here. So for instance, okay, I'm going to go ahead and divide 3,360,000 by 672,000. Okay, so the result is 5. So finally, I can answer the first question: allocated manufacturing overhead. Okay, this for May 2014. So it's going to be 72,000 multiplied by 5, then multiplied by 0.99. So the final answer is 356,400. Okay, so we're looking at the USD. So that's the first answer we have here, and that's for May only. Okay, so be careful. Okay, now we are going to put the 2, 3, 4, 5 together, because basically we're looking at the 4 we call it 4 variance analysis. So we have to put all things together to figure out the answer. Okay, so let's go ahead and complete the work. So first of all, I'm going to go ahead and let me put the 2 to 5 here. So I'm going to first talk about variable manufacturing overhead. Okay, so because for the variable and the fixed, we have a totally different calculations as I addressed in our face-to-face lecture. So for this one, we're going to have actual costs, okay, pretty sure. And for the variable manufacturing overhead, the variance analysis is quite similar to direct materials, direct labor, so I'm not going to say very much, but you can easily find the issue here. So we have actual costs, we have a flexible budget, okay, and for flexible budget, we know that it's budgeted input, okay, and quantity, and then multiplied by the budgeted rate. Okay. So for the budgeted input quantity, we know that that's going to be the budgeted input quantity allowed for actual output. So I may want to change that because so that we definitely will not be confused. Okay. So we based on the actual output to figure out the budgeted input quantity needed, allowed. Then we find the budgeted rate. Okay, so we can then go ahead and find all the issues. Then we need somewhere in the middle so that we're able to figure out the spending variance. The spending variance for the variable manufacturing overhead is similar to the price. Okay, price variance we talk about in the direct labor and direct material variance analysis, but here we have different names, and we also have efficiency variance. So therefore, we have to create something in the middle. It's going to be kind of a hybrid of the actual and flexible budget. So we fix one thing, so we are able to identify the spending variance and the efficiency variance. Okay, for this one, we're looking at basically the actual input. Okay, they are multiplied by the budgeted rates. Okay, so the difference between the actual input and the budgeted input quantity allowed for actual output is basically, there is efficiency problem. Okay, for instance. In my budget, I may use say 3 direct labor hours for output, but the actual input quantity for single output may be 3.5 direct labor hours. So there is efficiency issue there. Okay, then the difference between these two, you can see that okay, I have the actual input and I have actual rate. So that's how you get the spending variance. For this one, then we try to get the efficiency issues. So first of all, let me go ahead to identify some numbers I know. I do know this number. Okay, if you just visit our slide here, we can find this number so easily. Okay, it's going to be basically the actual quantity. Okay, actual quantity we're looking at. So all you have to do is basically do the following. Did you see the last column here? This last column here says okay, for the variable manufacturing overhead for May 2014, I have indirect manufacturing labor supplies, so I'm going to add these two numbers. So the total amount is for actual manufacturing overhead costs. Okay, so I'm going to do that. So I'm going to I'll add 84,000 to 117,000. Okay, so I'm going to do this first. All right, so I get 201,000. Okay, everything is in USD. Let me make sure that. So next, I will need to find out actual input multiplied by the budgeted rate. Okay, so this one is quite interesting because you do have to take a look at what's going on there. Okay, so for actual input, okay, so for the actual input, actually it's pretty clear. So it says a total of 72,000 output units requiring 321,000 direct labor hours. Okay, so we're going to use 321,000 directly. Okay, no doubt about it. Okay, so we're going to do that. Okay, so the next question, how to find the budgeted rate. Okay, basically the cost per direct labor hour. So it's pretty straightforward. Okay, because we're looking for budget, so you read this table and focus on the variable MOH only. There are two components, and indirect manufacturing labor supplies. So we can actually add these two components, okay, 0.3, 0.2. So that will answer for the variable manufacturing overhead, okay, from that perspective. So how much is for the direct labor hour, okay, the cost. So that's the budgeted rate. Once again, the first four columns are completely from your budget, and the last one, that's from your accounting records during May 2014. Okay, so let's go ahead and figure out the calculation. So as I said, you're going to use this actual input, okay, then multiplied by the budgeted rate. So that's how we find this middle value. Okay, so go ahead and we multiply 321,000 by 0.3 plus 0.2. So we have two components in the variable manufacturing overhead cost. One indirect labor, one is indirect materials. Okay, so then that will give you the answer, which is 160,500. So that's what we have. So last one is about a flexible budget. So we need to find the budget input quantity allowed for actual output, multiply the budget rate. Okay, so that's how we do this one. I don't know if you're aware of that actually. The step one, or let me actually change this from question 2 okay, to question 5. So from question 2 to question 5, we can use the result from the question 1. The question 1 tells us, okay, the actual units manufactured and the budgeted direct labor hours allowed per unit. So that's exactly what we need for this number, the budgeted input quantity allowed for actual output. So we're going to multiply the actual units by the budgeted DLH allowed per unit of product, so that we can figure out, okay, the budget input quantity for actual output. Then we have a budget rate. Okay, the budget rate, that's for actually variable manufacturing. So you cannot use 0.99 because that's for the total manufacturing overhead, including the fixed and the variable. So we focus on the variable part. So we're going to use the same number that we use here, which is 0.5. Okay, so that's pretty clear. So therefore, let's go ahead and finish the calculation. We have a 72,000, then multiplied by 5, which is from the question 1, then multiplied by 0.5. Okay, so the answer is 180,000. 180,000. Okay, so now we can go ahead and find the answers. So first of all, we can find the difference between these two. Okay, and that's pretty simple. I'm going to use a put absolute value here because I don't need to know the positive or negative. I will figure out the rest by myself. So I have 40,500. Okay, you can see that there's apparently unfavorable spending variance. Okay, so I'm going to make this red. That's my kind of style. I'll make this red, so that's unfavorable, and that's a spending, okay, variance. Then I can go ahead and find a difference between these two, okay, so that I will know the efficiency variance. So it's not too bad. So just to go ahead and compute the differences. Okay, so I get 19,500. Okay, so I do have good news here because I do have a efficiency improvement. So you can see that here, it's a lot smaller, and it takes less time to manufacture the 72,000 units as I thought, as I plan in my budget. So therefore, we have a better efficiency. Okay, better efficiency. So it's now we have the problem resolved here for the spending variance and efficiency variance for this one. Okay, so that's what we have here for the variable manufacturing overhead. Okay, so now we're going to talk about the fixed manufacturing overhead. The fixed manufacturing overhead is very interesting. It's very different. So we are going to talk about spending variance and production volume variance. And keep that in mind that the variable manufacturing overhead does not have production volume variance. Okay, the fixed manufacturing overhead does not have efficiency variance. As I said, it's very difficult to talk about the efficiency variance from a fixed manufacturing overhead perspective. For example, you manufacture 10,000 units, you manufacture 100,000 units. How can you relate the efficiency of manufacturing these different units to the property tax or the insurance payments? Because ideally, the insurance payments and the property tax are basically calculated using the vendor's model or government model. So basically it's out of control, it's totally independent, it does not rely on your productivity, efficiency, or price, whatever. It's actually just objectively there, and you have to respect. So therefore efficiency variance is never used in the fixed manufacturing overhead. So, but we do have a spending variance there, and that's for sure. And we do have production volume variance. As I said, production volume variance has no actually, no any meaning in the fixed manufacturing overhead. So let's go ahead and outline the variances here. So we have actual costs, definitely, all right, and that's the first we have. Then we have so-called flexible budget, okay, which is similar, okay, that's regardless of output level. Okay, then we have the allocated, okay, budgeted input, okay, allowed for actual output, okay, then times budgeted rate. So you can see that it's very tricky here. The definition for the flexible budget in the fixed manufacturing overhead actually is very different from the definition of the flexible budget used for variable manufacturing overhead. You can see that. And we don't have actually a name for the formula which we used for the variable manufacturing overhead for the flexible budget. So it's very tricky here. You can see that this one is very similar to that one. Okay, very similar to that one. Okay, but it's different. You can see that we don't consider they're the same. Okay, and we have a flexible budget formula which is identical to something we don't even bother naming it. Okay, so that's kind of tricky here. Okay, and we also have this one called a same budgeted, okay, same budgeted lump sum, okay, and once again regardless of output. Okay, so that's overall we have 4 elements that we're going to use to figure out, okay, to find out the spending variance and the production volume variance. For the actual costs, let's go ahead and visit the table again. So for the actual costs, that's what we have here. We're going to add 41 to 55 to 88,800. So that's how we find the fixed manufacturing overhead. Okay, the actual cost. So let's go ahead and do that. Okay, so we're going to have 41,000 plus, okay, and 55,000, then plus, okay, 88,800. Okay, so we get one. Let me double check that, make sure the calculation is all right. Okay, so we have 41,000 and hold on a second. So all right, so that's what we have. So apparently that's what we have. So called the actual fixed manufacturing overhead cost, which is 184,800. Okay, so let's go ahead and find the budgeted. For the budgeted rate, it's actually quite easy to find out, because all you have to do once again visit this table, then add the budgeted numbers together. So we're going to do that, and it's going to be pretty easy to find out. We're going to add 47,600 to 600 to 30,800, then to 58,800. Okay, so we have 172,200. So that's this number, and the flexible budget actually is the same as your budget, so 137,200. So these two numbers are actually identical. Okay, and let me put equal sign. Okay, so basically these two numbers are identical. Okay, so regardless of output. Okay, regardless of output. Okay. This one is a little bit tricky, so we're going to kind of assume that, okay, apply that the flexible budgeted, the rate, to figure out, okay, if I consider that's a variable, okay, what kind of a number we're going to derive based on this formula. Once again, it has no meaning, just tell you the production volume variance, okay, so that you're able to remember in the last table I'm showing you the layers. Okay, when we come to the bottom, their production volume variance coming from somewhere to balance the overall variance analysis. So that's the purpose of having that. So I'm going to go ahead figure out, okay, the budgeted rate, and then find out, okay, the allocated budget input allowed for actual output. Okay, so that's going to be pretty much the last complicated calculation. Then after that we can figure out the variance analysis. Okay, so let's go back to the table again. So this is basically what you have here. So in order to find the fixed manufacturing overhead per direct labor hour input unit, all you have to do is basically add three numbers together. There are three rates here. You add them, then the total is total fixed manufacturing overhead per direct labor hours. Okay, so it's pretty easy to add them. You add them together, you get a 0.28, then 0.49. So the fixed manufacturing overhead per direct labor hour input unit is 0.49. So we're going to multiply 0.49 by the budgeted, budgeted input of direct labor hours allowed for actual output. So once again, we come back to the question 1. We have actual units, we have budgeted efficiency, the direct labor hours allowed per unit of product. So we're going to multiply these two numbers to figure out allocated, basically the budgeted input allowed for actual output. Okay. So it's highly similar now. So let's go ahead and complete this calculation. We manufacture 72,000 actually, then multiplied by 5 hours. That's a budgeted number, the input direct labor hours for the actual unit. Then multiplied by 0.11 plus 0.17, then plus 0.21. Okay, so you get 176,400. So now we can calculate the difference between them. Okay, so for this one we can find the spending variance. Okay, spending variance. Alright, so we have a 47,600, and apparently this is unfavorable. Okay, unfavorable because we overspent the fixed manufacturing overhead. So I'm going to call that a spending variance, and apparently it's unfavorable. And for this one, actually not defined, so we don't care really whatever they call that. Okay, for this one we have the production volume variance. Okay, this one is pretty easy. Okay, and just calculate difference between them. Okay, so for this one we have a 39,200, actually favorable. Okay, the favorable. I'm going to put that in the green. Okay, so that's the production volume variance. So once again, this doesn't mean anything, and we have a spending variance here. So finally, actually, we can summarize all these analyses together. So what I'm going to do is I'm going to start a table here so that we can clearly figure out the differences. So this is called a 4 variance analysis. We have a variable manufacturing overhead, we have a fixed manufacturing overhead. All right, then we have spending variances, okay, and we have so-called efficiency variance, okay, and we have production volume variance. Okay, so let's put the number here. So for this one we have 40,500 unfavorable. For this one I have 47,600 unfavorable. And for efficiency variance here we have 19,500 favorable, and this is not available. Okay, not applicable. And for this one it's not applicable, and we have 39,200 favorable. Okay, and we're looking at the USD. So I'm going to put that into these numbers in red. Okay, that's unfavorable, and this is actually the favorable one. Okay, same here. Okay, so that's pretty much all the questions. So they are answered, and I want to emphasize a couple things. First of all, production volume variance does not explain anything. So it's just a number actually will balance, will reconcile, okay, with the entire variance, because you do have a little left here, which is this part. For efficiency variance for variable manufacturing overhead, once again we can talk about the machine maintenance, we can talk about the usage of materials, and skilled worker, or maybe machine is more advanced, the high quality materials, all kinds of things, supplies, okay, skilled workers. The spending variance for variable manufacturing overhead is pretty clear. So there are many reasons. For instance, could be the maintenance worker salary go up. That's why they have they are very experienced. You have to pay them more, so they have a high efficiency, but you have to pay extra labor. Okay, that's one thing. The second thing is think about the materials usage, high quality supplies. So that's why efficiency has been there, but they definitely have to pay more. For the fixed manufacturing overhead costs, why is unfavorable? Well, there are many reasons. So one of the reasons could be, well, the government just increase the tax rate for the property tax, or maybe the insurance company just charge more money for the insurance, or could it be the the depreciation changes, because maybe you think, well, we have 5 years left for lifetime left for that particular equipment, but actually it has only 2 years, so you have to accelerate depreciate the machine. So that's kind of issue happening. So there are many reasons causing those variances, and you definitely want to make sure you can find the reasons and talk to those plant managers and workers, and figure out, okay, what the list of possible reasons. Then you definitely want to find the one that makes the most of the sense to the result. Alright, so this is pretty much about this video lecture, and I hope that helps you understand the whole topic. Alright, if you have any questions, feel free to talk to me, and I'd love to help you, and have a nice week. Thank you. Thank you for watching.